The private credit system, once sold to the world as the smartest innovation in modern finance, is now under the kind of stress that insiders hoped would never be revealed. For years, it was promoted as a safer alternative to traditional banking, a place where institutional investors could earn higher yields without exposing themselves to the volatility of public markets. It promised stability, control, privacy, and attractive returns. But behind the polished image and confident marketing, cracks were forming, cracks that were small enough to hide during the boom but large, enough to become catastrophic the moment conditions changed. Today, those cracks are opening into fractures, and those fractures are beginning to resemble the early stages of a full-scale financial rupture. The mystery haunting analysts is simple yet unsettling. If private credit was supposed to be the solution to risky banking practices, then why does it now look like the biggest financial bubble of the decade? To understand how we arrived at this dangerous moment, we need to go back to the years after the 2008 financial crisis. As global banks collapsed under the weight of toxic mortgage debt, governments stepped in to enforce strict regulations. These new rules, like higher capital requirements and tighter lending standards, were designed to prevent banks from taking excessive risks, but they also created a massive void. Many companies, especially those with lower credit ratings, suddenly couldn't borrow from traditional banks anymore. And that's when private credit quietly emerged from the shadows. These were not banks, but funds, private entities with enormous pools of money coming from pensions, sovereign wealth funds, insurance companies, and wealthy clients. Firms like BlackRock, Apollo, Ares, KKR, and Carlyle realized the world had entered a unique moment. Businesses were desperate to borrow, banks were restricted from lending, and trillions of dollars worldwide were earning almost nothing due to record low interest rates. Within a decade, the private credit market exploded from a niche $250 billion space into a multi-trillion-dollar juggernaut. It became one of the fastest-growing corners of global finance. Deals were structured fast, terms were flexible, borrowers didn't have to face the public scrutiny of bond markets, investors were hungry, and lenders were eager. But this rapid growth came with a hidden danger. It happened in the dark. Unlike public bonds or regulated bank loans, private credit deals were negotiated privately. There were no public disclosures. Everything from the borrower as true financial health to the loaner's internal risk rating remained hidden behind closed doors. It was an opaque system built on trust and confidence rather than transparency. And for a while, that confidence seemed justified. As long as interest rates were near zero, everything looked perfect. Companies borrowed at cheap rates, private lenders collected attractive yields, investors received steady, predictable returns, but beneath the surface, a dangerous pattern was forming. Borrowers were taking on enormous amounts of debt, far more than they could handle in a normal interest rate environment. Private equity firms acquired companies using heavy leverage, some 7, even 8 times their annual earnings. Protections for lenders, known as covenants, disappeared almost entirely. Companies grew dependent on refinancing. Everything relied on the assumption that interest rates would stay low forever. That assumption turned out to be a fantasy. When inflation surged globally in 2021 and 2022, central banks had no choice but to raise interest rates. And they didn't raise them slowly, they raised them at the fastest pace in nearly half a century. Suddenly, companies that had borrowed at 4 or 5% were facing refinancing rates of 10, 12, or even 15%. For many businesses, interest costs alone consumed almost all their earnings. And because private lenders had issued loans on floating rates, rising interest costs were instant, unavoidable, and devastating. What had been marketed as a stable asset class was now transformed into a ticking time bomb. The early signs of stress appeared quietly. A few private equity-owned companies began missing interest payments. Some asked for extensions. Others began restructuring their loans. At first, these incidents were dismissed as isolated problems, not systemic ones. But analysts soon realized the distress was spreading across multiple sectors: healthcare, retail, manufacturing. Many companies that had thrived during the low-rate era were now drowning. The warning signals grew louder, but private lenders, afraid of triggering panic, downplayed the risks. They stopped marking down their assets even when borrowers were under obvious pressure. In the public bond market, prices dropped when companies weakened. In private credit, lenders could simply choose not to adjust valuations. They could hide problems on paper even as borrowers collapsed in reality. The breaking point began forming when a large wave of maturities approached. By 2025 and 2026, Hundreds of billions of dollars in private loans needed refinancing, but refinancing at new interest rates meant many companies would not survive. Their earnings were too weak, their leverage too high, and their cash reserves too small. Private lenders began facing a dilemma with no good outcomes. If they refinanced at lower rates, the lenders themselves would lose money. So many funds attempted a third option: extend and pretend. They extended maturities, delayed payments, or restructured loans in creative ways that kept companies alive temporarily. But these solutions were band-aid fixes on a bullet wound. Debt did not disappear. It simply grew larger and heavier. As more companies entered distress, private credit funds began facing their own crises. Investors who sensed trouble started requesting withdrawals. But private credit is not like a stock or bond fund. You cannot simply withdraw your money at any time. Many funds are locked. Others have gates limits on how much capital investors can withdraw in a single period. As redemption requests increased, several funds froze withdrawals entirely. This triggered fear across the industry. If investors couldn't get their money out, it meant the system wasn't liquid. And if the system wasn't liquid, it meant valuations were not real. The illusion of stability was falling apart. Banks began worrying too. Even though private lenders are not banks, many banks finance private credit funds or hold related assets on their own balance sheets. When banks realize private credit loans are deteriorating, they start tightening lending further. This creates a chain reaction. Companies lose access to financing. They cut workers. They shut down facilities. They stop investing. Small cracks become large fractures. The private economy begins to slow. And because private credit is deeply embedded in corporate America, the damage spreads across supply chains. The stress also begins affecting pensions and insurance companies, two of the largest investors in private credit. If these institutions suffer losses, it impacts retirees, policyholders, and public budgets. Attempts to contain the situation have repeatedly failed. Regulators have issued warnings, but lack authority to oversee private credit markets directly. Central banks cannot backstop private funds the way they backstop banks. Investors don't want to accept losses, and lenders don't want to admit mistakes. Private equity owners use aggressive strategies to delay financial reporting, shift assets between subsidiaries, or negotiate emergency deals to keep companies alive. But none of these tactics solve the underlying problem: too much debt, too little transparency, and borrowers who cannot handle higher interest costs. By now, the parallels with past financial crises are impossible to ignore. Rapid expansion, low interest rates, opaque structures, aggressive lending, and a system that looked stable until rising rates exposed how fragile it really was. Today's private credit boom resembles that pattern almost perfectly. Analysts who once celebrated private credit as the future of finance are now warning that it could become the source of the next major crash. Some even call it the largest unregulated bubble in modern history. The numbers confirm the danger. Loan covenants are weaker than ever. Borrowers are more leveraged, and the majority of private credit loans originate from the riskiest segment of the corporate world: middle market companies with inconsistent earnings and limited access to capital markets. These companies cannot survive a prolonged period of high interest rates. Yet, rates remain elevated and may stay that way longer than expected. The situation becomes even more alarming when we consider how interconnected private credit has become. When a private lender gets into trouble, the damage does not stop there. It spreads to the companies they finance, the private equity firms that own those companies, the banks that provide credit lines, the pensions that invest in these funds, and the workers employed by these heavily indebted firms. Private credit is no longer a niche. It is intertwined with the broader economy in ways invisible to the public. Looking ahead, three realities are impossible to escape. First, the private credit bubble is approaching its stress limit. Borrowers cannot refinance at current rates without significant restructurings or defaults. Second, the opacity of private credit makes the crisis more dangerous than traditional banking problems. Hidden risks cannot be evaluated, and unknown losses cannot be contained. And third, the next economic shock, whether from inflation, geopolitical instability, a recession, or a shift in investor sentiment, could push the entire system past the point of no return. The bubble does not need to burst violently. It can deflate slowly, painfully, and unpredictably. The world is now entering a phase where private credit will either adapt through painful restructuring or collapse through systemic failure. Investors must prepare for volatility. Companies must confront the reality of expensive debt. Policymakers must acknowledge the risks of an unregulated lending market, and individuals must understand how deeply private credit affects the world around them. The financial world is more fragile than it appears, and the private credit system is at the center of that fragility. If this breakdown helps you understand how close we are to a major financial turning point, then make sure you subscribe. Stay informed and prepare for the updates coming ahead, because this story is only beginning, and the consequences may reshape the global economy for years to come.